Hey, thanks for joining us today. This is going to be a treat. I got our IUL guru, Jason Herring, with me today. Jason,
I
welcome.
see. Thank you.
And we were talking about the question of when it's more advantageous to use an IUL versus a high cash value whole life policy and vice versa. That's one of the big questions, one of the main questions of a lot of the visitors and the clients that I know you've worked with. It's one of the initial questions. And as a bonus, I know you're going to talk about how IULs, you got a lot of different things going on with IULs right now, different indexes that are
Yeah.
customized. And so when you're trying to put cash into an IUL, what to know about that. But I know before we get there, I know you want to address the question, when is it a good idea to use an IUL versus whole life and vice versa?
No, it's a great question, and it's one that a lot of our clients come to us with because, you can't turn on social media today without seeing discussions about overfunded whole life. But unfortunately, a lot of times people are not getting the full story on when is that cash value it's accessible in an IUL. So if a client is coming to us and they want to look at an overfunded strategy, but they really need that cash value very quickly. Maybe they're a real estate investor. They want to put the cash in the policy, turn around, put it back out to work for them. Can't always do that right away with an IUL. And unfortunately, that's not the story that's being told. 15 years of doing this and designing probably thousands of different illustrations and contracts, when policies are available for cash, loans and when policies are not. And so to really kind of break down your question, you really want to make sure that you understand what the client's goals are. If they need cash value very quickly, the IUL is not the best strategy for them. I think overall the IUL is the better strategy for potential larger returns in the cash value over a period of time than whole life. But if a client really needs cash value right away, the whole life chassis is going to provide them with a much higher cash value number in the early stages. Early stages being, anywhere from 30 days after the policy started until, 6 months down the road.
That makes perfect sense. And the long-term possible growth relates to the index, correct? And the way that an IUL is designed, having a floor and then a potential for higher gains.
Absolutely. And the IUL strategy works best, I believe, that when a client comes to us and they want to just mimic some type of tax-free retirement source. Maybe they're making too much money for a Roth IRA and they're just frustrated. They don't have after-tax opportunities, tax-free opportunities down the road for tax-free retirement income. That's a great client for an IUL because we're not looking to access the cash very quickly. We have time to get through some of the first and second and third year maybe growing pains with an IUL as far as from a cash value standpoint. And then, that contract has an opportunity to turn into something pretty special for them with that, potentially larger returns as compared to what a dividend from a whole life, a dividend from a mutual company can provide. But it's just not going to provide that upfront cash value that a client needs or that they think they can get from watching all these other videos that they're seeing on social media.
Unpack that a little bit more, Jason. Why is that you put money into an IUL and it's just not ideal right away for taking cash out?
Well, inside of any type of a universal contract, you have two buckets of cash value. So whether it's a variable universal life, an index universal life, or just a standard universal life policy, you've got two buckets of cash. And that first bucket is your gross cash value. So that's the full amount that's inside the policy. But every universal life policy has a surrender charge. And a surrender charge only comes into play if you walk away from the policy in the first several years, first, 10 to 15 years. If you do that, a company has a lot of money invested in you early to get through the underwriting process, to deal with all the case management, and they don't like you to walk away early. So if you walk away from this contract early, they're going to keep a portion of your cash. Well, what nobody is telling you in social media today is that you can only borrow from your surrender cash value. That gross cash value doesn't mean anything. So you might look at your online statement and you see that you've got $10,000 of gross cash value, but you might only have $4,000 available of surrender cash value. So there's just not enough information out there right now. And that's one of the things that I think we do a great job is just being brutally honest with our clients and explaining to them you don't want any surprises when you're putting 10, 15, $20,000 a year into these contracts. We want to make sure you understand exactly what you're going to have access to when you're ready to have that access.
So that makes sense. So that surrender cash value is going to grow within the first few years substantially to where, say, year 3 or 4, you might have enough surrender cash value there to make a loan, utilizing that money makes sense.
Absolutely, because the policy is going to be designed correctly. So even though you have those surrender charges, which are going to limit the amount of cash value you have in those maybe first 1 or 2 years, if the policy is designed correctly with very, very low death benefits, so that the majority of your premium dollars are going to the cash value account, not to the cost of the contract, then it's not like you have to wait forever. You're going to have a significant amount of cash value there years three, beginning especially in year 4. You just don't want to go into an IUL thinking that you're going to put 15,000 in and you're going to have 12,000 available in 30 days for a loan. It's just not going to happen. And there's a lot of people that are upset, when they're not really explained to and really coached on what are your expectations and what are the realistic expectations of this contract.
Yeah, and it seems like a lot of people focus on one or the other. So maybe somebody that wants a straight up infinite banking program where they can take early cash value loans and leverage that way, they're going to be disappointed if they're dealing with somebody that only deals with IULs if they don't get the complete picture from
Right.
that person.
Yep.
So, Jason, let's segue to the bonus. The bonus is that when you put cash into an IUL, it's going to be based, you're going to have an option to select the index. There are a lot of interesting things going on with indexes. And it
Yep.
relates to your other point about the potential for high gains. So I know you're pretty conservative also in the way that you talk about indexes and potential gains
Yep.
caps. Let's dive into that a little more. How do you handle that with your clients?
Well, I think to really understand how you handle it, you have to first educate on what's happening inside an index universal life policy. This is a fixed contract. None of your money is invested in the market. All of your money stays at the insurance company, and the insurance company they're going to credit your cash value based on how well an index performs. And, most every carrier out there is going to have their core index, which is the S&P 500, and it's a nice index that you can track. You can pull up the S&P 500 every day and track. But in this industry, there's a race as well to build the next best and greatest IUL. And the way they're doing that is they're doing it through what I call designer indexes. So I tended to favor the S&P 500 because it has the longest track record of history. A company sets some of their maximum illustrated rates inside these contracts based off of how that product would have performed if they did a 65-year look back on the S&P 500. So we've got a lot of data to work with there. Some of these newer designer indexes, things like the JP Efficiente, the JP Morgan Mutual of Omaha has a brand new index out called the JP Morgan Volatility Control. Some of these companies are offering these, and they have extremely high participation rates. So, what do we mean by participation rates? These are things like if this index for 1 year did 8%, then maybe they're offering a 200% participation rate. So you would get 200% of 8%. So it's a way to go after some very, very large returns and still have that floor 0% protection.
Yeah.
So it's extremely attractive, but you have to really caution a little bit around what type of historical data do we have on these? A lot of these indexes are very new. We actually have a carrier out there when they're discussing these designer indexes, they actually use a term called actuarial judgment. And what they're meaning there is that we don't have the data to look at. So, but we're using actuarial judgment to project what these indexes could possibly look like based off of similar indexes. And so I'm certainly not opposed to using these indexes. I don't like people choosing IULs based off of these indexes because all of them, just like anything we do in life, whether we have an offer to move from one phone carrier to the next, or maybe from one cable company to the next, everybody starts with a really nice low price. But, once you become a customer for 3 or 4 years, all of a sudden those rates, can skyrocket. These participation rates are not guaranteed at 200%. Some of them might only be guaranteed at 65%. So you want to make sure you're choosing IUL chassis, the correct carrier, based off of how have they performed using the S&P 500. And then from there, we can look at these designer indexes and say, do we want to blend some money in to maybe control some volatility when S&P 500 is down? Because the option pricing for S&P 500 is much more volatile. So that's why all these companies are starting to create these designer indexes, because the option pricing for the carriers is much, much lower and they can offer these much higher participation rates.
So to interpret what you're saying, Jason, people need to know what they're getting. They need to have things explained to them. They get some control over these indexes and how they choose whatever percentage of the account
Yeah.
goes. And there's a right way to go about that. Thank you for sharing. And if you are watching this and you're interested in looking at IULs, you look no further. We love working with Jason because he does this stuff right. And we always encourage people to look at your own numbers. You can have your input all put into a policy, have it illustrated, get a full explanation of the indexes and the history of the company, like Jason's saying,
Yeah.
apply to the S&P and get any other questions answered. So wherever you're watching this, you'll have an opportunity. You can schedule a one-on-one, no obligation with Jason to go over this process and how this can work. And Jason, thank you for the
Yes, sir.
feedback on the whole index battle. Very interesting. You think about these companies trying to keep a foothold and having the best product.
Yeah.
And so buyer beware, of course, and you need the right person helping you. If you've had a good or bad experience, you want to leave it in the comments. We're happy to respond. And also, if you have questions, leave it in the comments. We'll make sure to hit up Jason to
Yeah,
respond.
for sure.
And Jason, we know we're going to be doing more of these and looking forward to having you back. Thanks so much for joining us.